welcome to this month's Fintech Firebrand. I'm Virginie O'Shea, founder of Firebrand Research, and I'm here to chat to you about this month's Fintech and finreg news. Now, as usual, August can be a little bit quiet with regards to finreg. There have been fewer than normal proposals floating around, but the ones that have hit the decks have done so with some degree of noise, some would say. So the Securities and Exchange Commission in the US proposed its new crypto regulation, handily known as the US crypto assets rule. And it's going to be regulation crypto assets, and it's going to be out for public comment and for 60 days for the rest of the industry to have a look at it after being published in the Federal Register as normal. It seems to be trying to make it easier for crypto projects to raise money in the US, and it sets out some safe harbors under which these assets can be exempt from being defined as part of an investment contract. Now, there are two aspects. The first caps fundraising at $5 million over 4 years, and the second allows up to $75 million in any 12-month period. Both of these exemptions require issuers to give investors disclosures about the offering, and there's also going to be a discussion about exactly how transparency is going to work in here for investors as well. So there's been a lot of fanfare, as you would expect, from the SEC about this. It seems to be in direct response to the fact the US Clarity Act, which has been mired in US Congress for quite some period of time, does not seem to be making progress. It's been sort of mired in discussions for about 2 years now. And there are certain ethical components of that have been both sides of the House have been disagreeing upon. Unfortunately, the August recess came in before it could be agreed upon and a final rule discovered or disclosed to the market. So we are waiting until September for discussions to resume, and that does not mean Clarity Act will pass in September. Don't forget, we also have the US midterms coming up, so that may also delay things. It may also mean that the rule does not get passed before the end of the year as well. It could, mire it further. So definitely interesting to see the SEC take its own steam to create a rule here. It's not unheard of for that to happen. But definitely isn't in keeping with the norm of these procedures. So, and it could see, I know that there's been some industry backlash to the notion of an innovation exemption for a while from the TradFi markets, the more traditional end of the markets, and unfair or unlevel playing fields being created across the crypto world and the traditional world of assets. So it will be interesting to see how much pushback there is from the industry, but definitely one to watch as September creeps closer to for us. The CFTC, on the other hand, from the commodities and derivatives side of things, has been mired in lots of discussions, again, related to prediction markets. There's been a set to with the New York state regulator about various aspects of banning certain contracts that are being proposed from the prediction markets. And there's going to be more and more lawsuits, one would expect, in the coming months on this topic. The CFTC commissioner or chair, Michael Selig, has vowed that they will be continuing to push on with championing prediction markets as an option for investors, though up until this point we have seen it primarily as a retail investment asset rather than an institutional, though we do see some of the largest, I guess, hedge funds dipping in and out of those markets, if we can classify them as such, every so often. So it's interesting to see that these prediction market firms are also trying to push into markets outside of the US with varying degrees of success thus far. We have seen a lot of discussion about it being moved to Europe, which is probably unlikely given MiFID rules, but we can but wait and see what happens. Now, we've also had lots of discussions throughout the year about the topic of 24/7 trading, or 23/5 trading, as it currently is being proposed in the US market. Towards the end of last month, we also saw the London Stock Exchange Group make its own proposals for setting up an entirely new venue for longer hour trading for the market. So that would be entirely separate from the current market or markets that LSEG operates. It would be its own thing. It would be called its own thing and related to being 24/7 or 24/5. And it would be only a select group initially of different exchange traded products that would be offered on the market. So lots of interesting developments to see. That will be interesting to see what the other European exchanges make of it. Thus far, we have not seen anyone make a big announcement outside of the US, the UK and Hong Kong looking at this particular topic. So definitely interesting to see if hubs in Germany, France and Holland, for example, or the Netherlands, will make similar moves given the focus on European competitiveness. And another very popular topic that comes up every 5 minutes is artificial intelligence, particularly frontier AI. Now, we've seen a lot of different regulators, IOSCO, the FSB, the Bank for International Settlements, all having a look at this particular topic over the last couple of months. We've seen numerous warnings, particularly as we saw Anthropic and OpenAI admit that they'd had some rogue agents hacking into various companies and acting on their own steam. So this has become a very high priority topic for regulators. We've had, publications from ESMA, the ESAs, I should say, not just ESMA, the European level supervisory authorities in concert have put out warnings about this sort of operational resilience aspect of frontier AI and the need to focus on cybersecurity means around the topic of frontier AI. So definitely expect more of the same going forward. There's also the possibility of OpenAI and all the other large tech firms coming together and staggering or slowing down the process of development of AI. But that would have to be global agreement. So not really sure we're at a point in history where that's going to be very easy to achieve. But definitely, and also with regards to competition and the arms race that we see in the AI world, not sure if it's realistic, but definitely there's been more discussion about how to slow down progress to be able to allow governance frameworks and ethics and all of these important things to be introduced, and regulation and regulators to catch up with the development of this technology. Definitely one to watch, definitely will be a big talking point in all of the upcoming events at which Firebrand and the industry will be attending, no doubt, across the globe. So definitely keen to hear from the market on that topic. And on one of my other favourite topics, T+1, we've seen this month one of the execs from the Financial Conduct Authority put out a blog or a piece of content talking about T+1 progress and some of the concerns the regulator has about the lack of progress in certain demographics. There were certainly some very strong words included in the piece about the need for third-party providers, third-party administrators and vendors and custodians to provide more detail to their clients about the required changes that they have to make, and also to be more specific to those clients about exactly what's needed per type of client. So, grading things down into very precise terms for the particular demographics they may be dealing with. There was also concern about some of the smaller asset managers not having moved quite fast enough. From our experience, we've seen, some of the wealth managers in particular and family offices, as you would understand, the furthest away from implementation thus far, given we've got till the end of the year to do a lot of the middle office work. That's a bit worrying given we are in August already and it will be a very short time frame to get to December. So definitely will be more impetus there from the FCA. The FCA rep said that they would be taking a stronger line in terms of going in and speaking to different firms. So definitely expect to hear more from the FCA and potentially other regulators as we go forward. Now, my final thoughts for the month are really to do again back with the topic of tech and how fast we're moving as an industry. We've seen a lot of the tech bros out there saying that we're at the point of the singularity where machine intelligence overtakes human intelligence. What does that actually mean for the industry as a whole? What does it mean for human labor and effort? If we are now handing the best part of our jobs and the best part of our functions as humans within the workplace to a technology process or a technology agent, as they are now known. The best rebranding from bot to agent, making them sound much more intelligent and much more efficient in that firm. But definitely, we have to think about how that balance of work happens, how that transfer of responsibility happens, particularly as we're seeing AI agents taking on their own direction, as we've seen with some of the cybersecurity events over recent months. So definitely a lot of things to think about from a governance standpoint. And I think the industry is right to slow down the process of development. We cannot run before we can walk, and we need to walk to be able to understand exactly what the implications of all of these things are for the world at large and for being able to control these things. We need to have a kill switch if things do go wrong and make sure that we're able to control the situation. We don't want things escalating. We've seen enough Armageddon films related to robots and artificial intelligence to tell us that things can go very wrong if we let them. So certainly it's beyond the realms of capital markets here, but certainly something to bear in mind. Now, in the realms of capital markets, we also have to think about how individuals can cope if these structures are changing, if the way that we assess a corporate ladder changes fundamentally. What does that mean? What do soft skills contribute? What types of functions remain if a lot of the work goes to machines? And that definitely is something that we really need to think about as an industry and think about in a very serious manner as soon as possible.